Good evening, ma'am. Yes, I let me take this opportunity to introduce you to
Sure.
everyone, one and all. Thank you so much, first of all, ma'am, for joining us here.
Pleasure.
Vaishali Parekh, ma'am, she is the AVP, and she's in the technical research department since years. She's a commerce graduate with a technical analysis background. She trained extensively at the Bombay Stock Exchange with Dr. C.K. Narayan, one of the finest exponents of technical analysis in financial markets in India. With Prabhudas Leeladhar since 2006, she now leads the research department, which generates trading strategies. These could be investment calls yielding from returns from about 15% to 20%, positional trading calls, or short-term and momentum calls. From time to time, her views are sought by business channels such as CNBC, TV18, CNBC Bazaar, and ET Now. We are extremely delighted, ma'am, to have you here with us today. Your time and valuable insights would surely be very much beneficial to us. Over
Thank
to
you.
you, ma'am.
Thank you for having me. So now let's start with a brief introduction as to what technical analysis is. So I believe our audience today are all chartered accountants. So of course, they are so well acquainted with all the market strategies and everything. But how does technical analysis help us in creating trading strategies? That is what we are going to learn. It is going to be just a beginner's talk. So I will start with our lecture on technical analysis. So actually now stock market has always been a very, very hot topic. Wherever we go, everyone is very, very intrigued and is interested in knowing as to how the market is doing, what is the stock that one should get into, how is it going to benefit us by getting into the stock market. And so far, well, the history says that we have got phenomenal returns as compared to any other investment planning stock market. If traded or invested wisely, we get phenomenal returns. But now the idea is, now let's start between the fundamentals and the technicals. Fundamental, well, if we look at a broader horizon, it is more so for a investment strategy. It tells us seeing the macro situation, seeing how the company is doing, as to what the competition is. So this is what the analysis, what we generate from fundamentals. So fundamentals is always going to help us to guide us that what is a good script to get into. But at the same time, with the what, it is also very, very essential as to when. So this is where technical analysis comes in, that we are going to study with the help of our charts. So what exactly is technical analysis? Technical analysis is basically a study of charts and how are these patterns formed and what does it imply, whether you are following a line chart, whether you are following a bar chart, or whether you are following a candlestick chart. So of course it is on basis of the main ingredient to it is the price movement. And how does the price movement happen? It is only with the buying interest. That is what we see in volume. So here is a small note. Technical analysis is a study of charts developed by price movements of index, stock, or a commodity. So this rule is applicable whether you are getting into an equity market, whether you are getting into a commodity, whether you are getting into anything, crude, gold, silver, that is what we mean. So the rules of chart reading are the same for any platform. The objective of this study is to find the strength or the weakness of the trend. Now, one of the most important concepts in technical analysis is that of a trend. What do you mean by trend? Trend is like, you know, in a layman's language, we say that yes, market abhi bull run mein hai, market abhi bear run mein hai, और market में कुछ दम ही नहीं है, आज कुछ हो ही नहीं रहा है. So this is what we talk in a common day-to-day language. But what do we mean by a trend? When there is strength, when it is a bull run, the market is moving upward. Of course, it never moves in a straight line. It moves in whipsaws. So we do have the lower highs or the higher highs and the higher lows, which is giving us a step as to when would be an appropriate entry level, because if you would have missed out on the inception, on the first reversal, you still want to get into the stock, you would wait for the stock to see some retracement and wait for some support levels to get into the stock. So what is it that technical analysis is going to teach us? So there are now 4 assumptions, because we wait that let's wait for this news to come in, let's wait let's wait for the budget to come, but by then actually the opportunity is already gone. So this is our recent event which has taken place. Had you waited for the budget, you wouldn't have got into the stock at the right value or at the fair price. So market knows everything. This is what we can see from the chart. If there is any negative factor like what we saw in COVID in last January, well, we were still fearing, we were skeptical whether is it the right time to go get into the market. But our indicators, our chart patterns, they gave us a clear indication that yes, it is, the market has bottomed out and it is time to enter the market. So this is the recent events that we have witnessed, and that is why I'm using these examples. So this is what I mean by market discounts everything. That time the global market was so bad everywhere. People were skeptical to get into metal sector. People were not even willing to get into the stock market because they were fearing that yes, market में बहुत खराबी है, अभी business सब down है, 6 महीने के लिए there is no business, there is no rail, there is no movement, there is no global export import. But well, that was the time when we got the opportunity to get the stocks at a very, very cheap and a fair value. And that is what people who have invested at those levels are enjoying the fruits of it right now. So this is what we mean, market discounts everything. So when we as a combination of a fundamental and a technical, well, we can reap good rewards, because what and when we are in sync, so then you are going to get the maximum benefit out of it. So the price normally moves in a defined pattern and trend. So now as we progress, we will be studying about charts. You will always see that, well, it is not a gamble. What people, many beginners or many people who are not in the stock market, it is surely not a gamble. It is surely not a fluke. There is a lot of studies. You can call it a mathematical valuation, you can call it a science, but well, it is always in a particular method, the way the price movement takes place. And that is why we follow the Fibonacci levels, we follow the moving averages, we follow the support and resistance, because there is never an erratic move which a stock will get into. It is always in a defined manner. So it could be, say, some of the stocks, each stock has a peculiar way. So the more you see the charts, you know that, well, this script is going to move like this. This is quite a laggard. Now, for example, ITC has always been the troublemaker, but when it gave the indicator, well, we got good returns. And some stocks are high beta stocks. That means when the market is going to move by 1%, you may get the returns by over 2.5% more. So that is what we call as high beta stocks. So each and every sector, each and every stock has a peculiar way of moving, and the chart formation also follows a particular system. So this is what we evaluate from the technical analysis. And how do we infer to our price projections? How do we come to our projected targets? How do we anticipate that yes, this is the support? Because history tends to repeat itself. So on the basis of the previous fall or the previous rise, the pattern formation occurs, and on basis of that we come to a projection that, well, this stock is ready to get into this price mode. This is what we are looking at. Well, it has come to a resistance level. Now we can expect it to correct, because history tends to repeat itself, and we are going to take our analysis on basis of the past movement of that particular stock. So this is how we are going to take it forward. Few basic rules which a beginner or an investor who has not been very vigilant on this has to make a note of. Every keen investor trader is interested in knowing what to buy, and when to exit. So this is what, because it's always the greed factor. Sometimes you know that the stock has come to a resistance level, and it is very essential to book your profit at that level. But well, we sometimes get greedy that nahi, market बहुत strength दिखा रहा है, we have to still hold on to the stock. And whereby what happens that, well, we see some profit booking, and the maximum, the cream of that stock, what we were going to maximize on our profit, we are deprived of because of the greed factor. So these are surely the points to ponder to become a successful trader and an investor. Always have a predetermined mind. regarding your time frame. Now, before you are going to buy your stock, if you are a trader, you have to decide, are you a trader for a week? Are you an intraday trader? Are you a positional trader? And on basis of that, you will always be very sure of how much loss you are going to be able to afford, how much profit, because of course the risk reward has to be very, very favorable. If all these criterias are met with, only then will you get into the stock. So first you will have to decide whether are you ready for an intraday play. Are you a positional trader? What is the profit ratio, profit level that you are looking at? Or are you an entry? Are you getting into the market with an investment purpose? So once you're sure of that, you will be forming your rules as per that. So the rule is, be a disciplined trader or an investor. A stop loss following is a must, because that is when you minimize your loss, and it will give you an opportunity to make up for the loss by getting into the other favorable trade. So once you are a trader, you have to form this habit of hitting your stop losses if and when necessary. Do not buy in the middle of the rally. Now, this is what we always come across every day, that well, when we give a call, the stock starts moving, and when we are already halfway the rally, the clients will ask, madam, abhi buy kar le. Please do not do that, because that is when your trade is not in a favorable risk reward ratio strategy. You are then going to see the downside also, because market is going to see whipsaws. We are never going to see a one way move. So the ideal thing is to wait for the support levels, buy close to the support levels, because if the stock has gone, the trade has gone wrong, you are very close to your stop loss levels. So it is always very essential to keep a note of having a favorable risk reward ratio. So now, as I said, do not be greedy. Once your strategy is made, once your target levels are set, please do book your profits, exit at the target levels. So the golden rule is, invest like a fundamentalist, execute like a technical analyst. Go long in strong stocks and sell short in weaker stocks. Because of course, once a market player is nervous that yes, there is something to happen in the market, they will always exit from the weaker stocks. So always very, very appropriate to go short on weaker stocks. Now, this is the difference between the technical analyst and the fundamental analyst. What exactly do we look at? As we spoke earlier, technical analysis looks at the price movement of the security and uses this data to predict its future price movement. As we said, that history repeats itself. Whereas a fundamental analyst was going to look at the economic factors, the balance sheet, cash flows, income statements to derive a company's value, while technical analysis believes that all this information is fed in, and that is what we see in the chart and the stock movement. So technical analysis can be used on a time frame of a week, a day, or even minutes. So that's what we meant. Whether you choose to be an intraday trader or a weekly trader or a long-term positional trader, depending on that, you can make use of a 5-minute chart to a weekly chart to a monthly chart, but the rules are going to remain the same as to how you are going to read your stock. Whereas fundamental analysis takes a long approach. It could be for a year or even more. So that is totally an investment concept. Technical analysis is used for a trader, whereas fundamental analysis is used for an investment. So now to start with, as I said, it could be a line chart, it could be a bar chart, or it could be a candlestick chart. Now you got to suit yourself, but most commonly used right now is a candlestick chart. It is a Japanese study. Well, the detail about this, if anyone is interested in knowing more about these candlesticks or the bar and all, one can go on to Investopedia, because Investopedia is the site where one can very well get themselves acquainted with all the technical terminologies. So now let's start with the bar movement. As on my left, we see that the first stick with the small bars on the left and the right, they are showing the price movement for the day as to where it has opened. The left hand side of the bar, we see that well, the market the stock has opened at a particular value where we have indicated the open. It goes to a low and it then makes a high, and it closes close to the high level. So this is what we mean that it is in a strength. So this is a bull run strategy where we are seeing that the stock is closing close to the high of the day. So that means it is a bullish sign. Similarly, you see the candlestick. One is the white fat candle and the other one is the black fat candle. So you see that there is a strong, good price movement during the course of the day. You've seen that where the stock is open, it has made a low and quickly gone towards the high and close. So this is the white candle, which is what we have been seeing since 1 year now, and it is a bullish sign. Whereas the other way around, we see that it opens at a high, it makes a high, but it fails to stay there and it goes towards the low and closes towards the low. So this is what we had seen last year from Jan to March. And that is what showed us that, well, market is getting into the bearish mode. So, well, a series of these candles will make a trend formation. Now, as we spoke about the white candle, the black candle, and we discussed as to how the high-low is indicated on this. Now, there are a few other formations. Excuse me. So once a market, when it is in a continuous bull run or a bear run, one is waiting for a reversal. Sorry. So what is a spinning top? What is a hammer? What is a doji? So when we are seeing a strong uptrend, you will see a series of white candles coming along each day, and we are seeing new highs happening, higher highs. And whereas in a bear run, we see lower lows, and there is a series of black candles going lower, and we are seeing new lows every day. So that is the bull run and the bear run. But now we want to see, we want to take a call as to, is it time to book profit? Is it time to enter the market? So what do? You wait for a reversal. Now, these are the patterns, these are the candles which give us a hint. Spinning top, you see that, well, the market gave a very good high movement. It made a very good high. And now we have seen profit booking emerging, and we see that the stock has closed lower. So this is a hint that, well, market is showing exhaustion. It need not necessarily mean that it is a reversal. And well, for a confirmation, one must never rely only on one indicator or only on a one candlestick formation. You need to take support of at least one or two indicators with that, which we will be studying gradually, but this is just the introduction of candles. Now, hammer is the same thing, that, well, it is a small body, so means there is some buying interest, there is some holding of the stock at higher levels, if you can see from what this candle shows. Whereas doji, what is a doji? Doji is a candle where it is a tug of war between the buyers and the sellers. So now let me explain this to you in a very descriptive manner. When the market is continuing to be in a bull run, now hypothetically, let's talk about Ashok Leyland. Say Ashok Leyland started its rally right from 50. We continuously see a higher high. So 50, we see new candle coming up to say 70, 80, 90, 100, and then we see that there is a bull run happening. Now immediately, suddenly we see that there is a doji formation. That means what? There is a participation from the sellers too. So that is what we mean by a tug of war between buyers and sellers. So all along, right from 50 to 100, we saw only buying interest, saw big white candles coming along, and then one fine day we come across this doji line. So that is where it is a word of caution that yes, bulls are getting tired. There is not much of buying interest. There is profit booking emerging. And now if it is supported by fatigue in the RSI, that is the relative strength index, or a crossover of a moving average, these are the few indicators which we will be talking about today. That will be a hint that yes, it's time to be cautious on this stock. It is time to surely book some profit and then see the next round of momentum, how the market progresses or how this particular stock progresses. So this is how each and every candlestick formation pattern is going to teach us as to what it is telling us. It is a message that yes, come on, the rally is over. There is some sellers now getting active into the stock. So similarly, now as I have spoken about hammer, there are a few other candlestick patterns. Now to name a few, we spoke about hammer, we spoke about, now we will be talking about hanging man. and we will be also talking about bullish engulfing line and bearish engulfing line. So hammer, as I said, that well, the stock has made, we saw that the previous bars are all showing bearish. What do you mean by bearish? To come again, the first bar was the high, it closed at low. The second bar refused to cross the previous high, but it made a new low. The third bar, again, it made an attempt to come back to the high, but it did not cross the first high, and it is holding on. And then again, subsequent, we see that following bars are making new lows and a downtrend is forming. The last hammer which we saw, the market has made a low, the stock has made a low, whereby there has suddenly been seen that yes, okay, the stock is corrected to quite an extent, and we are seeing good buying interest, and where the close is coming close to the high. That means it is indicating that, well, the worst is over, there is some buying interest. But well, one cannot just make a judgment on only one candle. As I said, you need to take support of the supporting indicators along with the subsequent, but well, one can definitely start accumulating if the RSI is also indicating that yes, we are out of the oversold zone. If the moving average crossover also takes place, that means the stock is now ready for a pickup. There is some buying interest, it is good to accumulate. We have, the worst is over. Now, hanging man say it is the reversal, whereby we see the uptrend. Uptrend means the bars are continuing to make new highs and higher lows. So if you see, it is an uptrend. And suddenly the last bar that we are witnessing, we see that it has made a high, but the stock is not ready to hold on over there. There has been a sudden selling pressure coming in. And once again, there have been buyers at lower levels and holding on to the high, but it is definitely a word of caution because good selling has taken place at this price. So these are the indicators whereby it gives us a warning that, well, hold on to your buying strategies. You may either book or keep your trailing stop losses. Now, bullish engulfing and bearish engulfing is very, very interesting because that is a very, very strong indication as to the stock has bottomed out or the stock is peaked out. Now, bullish engulfing, as the word denotes, bullish engulfing means it is giving us a signal for a bull run. It is for a reversal from the selling. Post selling, the market or the stock has to witness some buying, whereby what do we mean by engulfing? So we see the previous candle. Uh, well, the stock has made a low. There is a black candle which shows market continues to be in the bear run. But now one fine day we see stock has made a new low, as we have seen that it has made a lower low. Well, we see a big white candle which surpasses the high, surpasses the previous high. So we have seen it is engulfed the previous candle, whereby there is good strength coming from the buyers. So now the sellers are weak and the buyers are strong. So this is a hint that yes, come on, exit your shorts if you are into the short sell strategy, or if you are waiting for a buying opportunity. This is a hint that yes, the bear run for now seems to be over. There is good strong buying interest, and this normally occurs when there is a institution buying, it is a big bulk buying. This is when we see that yes, the buyers are active. And same way the rule applies for bearish engulfing, but in a reversal. That is, once we have enjoyed the bull run, it is now time to exit the long positions and get into the short sell. Or if you are not an aggressive trader, that means you're only on the buy side, you may at least book profit and sit pretty till you get the next round of indication that yes, it is time to re-enter or it is time to go short or exit totally. Now, as we spoke about trend, in technical analysis, it is the movement of the highs and lows that constitute a trend. So as we spoke that yes, what is an uptrend, what is a low trend or downtrend, what is a sideways market? Now this pattern is an example of a very, very strong uptrend. Now, as I have labeled it as 1, 2, 3. So what happens once we see a reversal? We see one move coming from 1 to 2. Well, as we said, that market never runs in one straight line. It is going to see whipsaws, and at every juncture, at every resistance level, whether you take it as a support from the levels from the Fibonacci levels, or you see a Bollinger Band, or any other indicator, you will come across, or the previous highs, or the previous uh, peak, what you have seen, the stock tends to correct. It shows respect to the previous high, it shows respect to a pattern, and that is how we say that stocks always move in a symmetrical manner. So in this case, we see that market is moving in a whipsaw. But now, what do I mean by a strong uptrend? Now, 1 to 2 is one trend. We have seen the stock or the index rallying to a particular level. Now you see that the retracement, the profit booking has happened from 2 to 3. By strong uptrend, the retracement is never equivalent. You will have to gauge the distance traveled from 1 to 2 and 2 to 3. 2 to 3 is hardly anything. It is ready for a takeoff from 3 with a bare minimum corrective move. In a sideways market, or in a weak market, or in an indecisive market, what happens is the retracement comes to probably half or even more than half of the move what we saw from 1 to 2. That is what we say that how we are going to study the trend. If it is very, very strong, you see the retracement is only 2 to 3, which is hardly anything. Once again, we see that the stock has picked up. It has, and what is the confirmation? When it moves past the level which was made previous, that is at 2. So if the stock crosses that 2 level high, it means it is ready to make a new high. And that is what we say that yes, the stock is picking up, and it is in a formation of higher highs and lower highs. Higher lows and higher highs. So that is what we mean by a very, very strong uptrend. And like the similar pattern has occurred from 4 to 5. The retracement is hardly anything. It has not even come close to the midpoint of 3 to 4. And it's again ready for a takeoff. And once again, it crosses the 4 high and it is ready for a new high. So this is how we come to our price projections, and this is how we say we generate buying strategies. So this is a strong, good example of a strong uptrend. So similar pattern, but in a reverse manner, we will be seeing in downtrend. When the stock is making from high to low, it pulls back to a hardly any level. And again, it breaks the previous low, comes to a lower low to make a downtrend. And that is a confirmation. And that is how we prepare downtrend strategies. And sideways, what is a sideways move? When a market is not ready to cross the previous high, the market is not ready to break the support level, it just continues for quite some time in that same support and resistance level. And in such cases, well, you have to create different strategies. You will have to buy at the support levels, you normally exit at the resistance level, and you have to really be ready. You cannot be obstinate about this, that, oh, we are just getting this profit. You have to be ready, because this is one rule which one has to understand, that you have to respect the market trend. You can only get what the market is ready to offer at that particular time. You cannot be obstinate that yes, my aim is to get 15% return, my aim is to get 20% return. But if the pattern is not respecting your view, you have to be ready to accept that yes, this it is for now. I cannot be greedy, because you will be losing out on opportunities of even that small profit strategies. So you have to try and understand the trend, whether it is uptrend. Uptrend is the time when you get maximum benefit for the buy side. Downtrend is a time when you get maximum benefit for the downside, that is short sell. And sideways, it happens, and this is the way the market functions. So when we are in the sideways move, whether it is the index that we are talking about, whether it is any particular stock, well, some stocks really need a good gestation period. So it happens that, well, sometimes we see good volume, we see good momentum, and then the stock fizzles out, the steam is out for some time. So this is where your patience, your discipline comes into play, because this is the only way one can maximize on profit Once your rules are in place, your discipline is in place, and then there is no way. And of course, one learns the hard way after really getting a lot of beatings from the stock market. You have to understand that you have to respect what the stock market is ready to offer, and you have to respect the rules of technical analysis. So the importance of the trend, as we studied, it is important to be able to understand and identify trends so that you can trade with rather than against them. So what does this mean? This is always a very common sentence used. The trend is your friend. Now I'll tell you, and this is what we have witnessed just in the recent past, pre-budget. See, every time what happens is people are worried of the stock movement, and before the budget, people say that "Arey, budget to kharab hi hai, budget it's already factored in, let's go short sell and all." And people were really trapped. The short sellers were really trapped because they went against the trend. From the trend, we never got any reversals. Well, minor profit booking, but there was no obvious reversal. And if there was a reversal pattern, you had to quickly change your view once the market again showed signs of improvement. So this is what we mean, that trend is your friend. Only go as per the trend. Don't try to outsmart the trend, because market is much smarter than us. So don't buck the trend. That is another word which we use. And this is what we mean, because if you go against, you are either going to miss out on your profit strategies, or you will be in such a trap that rather than making profit, you will only land up making huge losses. Because these days people are getting, thanks to the rules laid by SEBI and all, people are not going aggressive or wild in their trading strategies, because there is compliance and all which is controlling all this. But otherwise, in the past, we have seen that people have really lost fortunes because they have tried to outsmart, and which can never be won. The rules, and this is where I again emphasize that follow the rules, follow your stop losses. Okay, your trend, your trades can go wrong, your views can go wrong. Even if you have gone against, you have tried to be faster than thinking that, yeah, your decision is going to be right this time. But if the indicators say that no, you are going wrong, respect that and change your strategy. So this is how we are going to use all the indicators and try to get the grip of the stock as to how to read a particular stock. So now, as we spoke about uptrend, downtrend, sideways, these are the examples what we have seen on one particular chart itself. As we have spoken about uptrend, what do we mean by here? We can see the chart, particularly we see the candles, the series of green candles showing higher highs and higher lows, getting into one particular up move, and that is what is an uptrend. Suddenly we see a doji up, which is a small red body on top, indicating that yes, there is a word of caution, the sellers are active. And from there on subsequent, we see that yes, selling has begun. The stock refuses to cross the previous high. It continues to make lower lows, and that is when the downtrend has begun. So similarly, how do we gauge the uptrend? We spoke about the engulfing pattern. We spoke about the candles moving the previous high, showing the signs of reversal. So that is when the uptrend began. So, and if you see the retracement, if you see the flow of this chart, you see the retracement right from the first uptrend. The retracement has taken by more than half the distance moved by the first rally. So this is what we say, that yes, there is no confirmation of a strong uptrend. And we saw that the stock is making double bottom. What do we mean by double bottom? Because you see the subsequent rally, it has taken support of the previous low, and from there on it was one way. You see this particular retracement, what we are talking about. Now, this retracement shows that yes, it is not ready to go towards the distance, not even half the distance of the previous rally. It has just taken support, making a minor retracement, and from there on, it has just crossed the previous high, confirming that yes, the next round of up move has begun. Now you see over here for quite some time, this is what we talk by sideways move. We are anticipating, we have a projected target of the higher levels, but well, it's taking a while. So this is what we mean by a sideways move. So market is waiting, it's taking its own sweet time. There is something, maybe they are waiting for some announcement, or there is some uncertainty whereby there is not much of a buying interest. The support levels are also not broken. The resistance levels are also not broken. It continues to move in a particular pattern well within the range. So this is what we mean by the sideways move. Then it gives a breakout. It has broken out of the resistance level, and then it gives its upward rally. And again, we see the reversals taking place. And see, this is where we have to learn that if the previous highs are broken, that means market is losing the strength and it is ready for a reversal. So had you been very wise of keeping your trailing stop losses, you have enjoyed your maximum bull run in this. And if you are an aggressive trader, or if you are a trader who can enjoy both sides move, you can get into the sell strategy, because this is where your risk reward ratio, you may just use your stop loss of a little bit above the high made and then go short. You will enjoy the good short sell strategy. So this is what we mean by good risk reward ratio, good understanding the trend, and the three types of trend: the downtrend, the uptrend, and the sideways market. So let's read this. This will help you to understand. A chart pattern is a distinct formation on a stock chart that creates a trading signal or a sign of future price movements. Chartists use these patterns to identify current trends and trend reversals, and to trigger buy and sell signals. The idea is that certain patterns are seen many times, and that these patterns signal a certain high profitability move in a stock. Based on the historic trend of a chart pattern setting up a certain price movement, chartists look for these patterns to identify trading opportunities. So now just many of whom are familiar, because these days who are fresh chartered accountants, you have the subject of technical analysis and derivatives. So you would be very familiar with double top, double bottom, triple top, or an inverted head and shoulder, or a wedge, or a flag. So these are the patterns what we normally look out for, and which I will be explaining in my following slides. So chart patterns, that is why we rely on all these things to infer to our further price projections. So there are two types of patterns within this area of technical analysis: reversal and continuation. So what do you mean? What is the difference between reversal and continuation? When there is an end of a trend and you see that, well, the stock is fallen below the midpoint, as we spoke, it is a confirmation of a reversal. And what is a continuation? When we use the common language, in new round of momentum, the uptrend continues, but now the stock is ready in the new round of momentum. That is what we see, that the retracement has taken place to a very bare minimum and not even crossed the midpoint of the previous rally. So that is what it shows. It denotes that it is in a strength. It continues, it is likely to continue with its upward move, and that confirmation comes when the stock moves past the previous high. So that is the difference between the reversal and continuation. A reversal pattern signals that a prior trend will reverse upon the completion of the pattern, and a continuation pattern, on the other hand, the signal that a trend will continue once the pattern is complete. These patterns can be found over charts of any time frame. Now here are the common examples what one would look for. Now, once you understand this concept, you will also be able to understand as to how much your target should be. This is a very commonly used pattern, and one often looks out for these strategies. So people who are familiar, just some time back when IndusInd Bank was at 500 levels, 450, 500 levels, it had witnessed an inverted head and shoulder pattern. And on basis of that, we had generated a buy call for our clients, and it gave us a very good return over a period of time. So now let us understand in depth what is head and shoulder, what is inverted head and shoulder. So now the first diagram, what we see, it is of head and shoulder. What do you mean by head and shoulder? As how we are, our shoulders are lower than the head, and that is what. So once when we are witnessing an up move, you see that, well, the stock has made one high, and that is the shoulder formation. How would we come to that? That is only decided once the head is formed. This is confirmed once the next rally takes place and it makes a higher high. And then you see that the third attempt to move past has been failed, but it just holds on to the previous shoulder length. So that is what we mean by the head and shoulder formation. So head and shoulder, one has to look for is a reversal pattern end of the bull move. So once when you are on an upward move and when you see such a pattern, and when the three support levels which we have joined by the trend line, you see that well, the previous support, the line which we have drawn, if that level is broken, that is a confirmation of a reversal and the stock is ready to correct. Now, how much? If you are a short seller, or if you are well already into your stock, but if you are going to look for next round as to when to re-enter, what could be an estimated level that the stock is likely to fall? So from this head and shoulder pattern, normally the fall, once the trend line level is broken decisively, that means the close has taken place below this trend line, you can infer a projected downside price target with the level which is equivalent, the distance between, hear me carefully, the distance between the trend line, that is this trend line, to the head. This price movement, what we are witnessing over here, the fall will be equivalent to this particular price movement, what we are witnessing from the trend line to the head. That much distance is likely to be covered downward. So this can be, so if you are a short seller also, one can infer, this is a rough estimate, that yes, the stock is likely to fall equivalent to the rise that has taken place right from the trend line to the head. And similarly, when you are looking for a buying opportunity, we are going to make use of the inverted head and shoulder pattern. So this denotes a strategy for the bull upward move, for a buy strategy, and the head and shoulder denotes a strategy for a short sell or exiting the stock. So let me explain once again. We have seen this in this particular diagram, that yes, the distance between, now once your trend line is crossed, it is a good buying opportunity. You see that two shoulders are respected more or less. The head formation is clear. And once we see a decisive move past the trend line, what is your anticipated target? Well, the rule is the same. It is the distance between the trend line and the head level. That much of profit you can easily expect. And then one can have a relook. Are we seeing just a minor retracement? Are we seeing for the further bull? But the initial price movement, initial price projection you can look for is, as per the rule, it has to be the distance between the trend line and the head. The rules are the same rules are applicable for head and shoulder and inverted head and shoulder. Now there is another formation, that is a rounding up bottom or a rounding up top. So normally you see either it is just a consolidation, it could not be a rounding up, it could be just a straight line, just there is no price movement, just there is a very inactive price movement, or it is a V-shaped recovery. Now suddenly you say, like example, in our market we saw many stocks having a V-shaped recovery. So that is when, you know, the stock has corrected, and then suddenly you see that yes, there is something, it is out of that negative news, or it is out, there is something, some good news come from the government, or some RBI rules or something, and we see that yes, the immediate bottom is just respected, and from there on the market has not given us a chance to retest the previous low. You see a quick upward move, that is a V-shaped recovery. Whereas a rounding up formation is what market is taking its own time, the stock is taking its own time, and this is a healthier move, that yes, the base is stronger at these levels, the top is also stronger at these levels. So rounding up bottom is a confirmation that yes, many a times the stock is trying to come to the support levels, it's not ready to break the previous support levels, it's only making an attempt. That means, well, it is a gradual move, and it is going to take a longer while to go up. And similarly, in a rounding up top also, that the stock, only thing that one needs to see is the bar, the current bar, ready to move past the previous high, or it is failing to do that. That gives you an idea that yes, we are not seeing a new up move coming in for some time, and gradually the stock will see some profit booking. So we just spoke about the other patterns, that is double top, double bottom. And this is what I mean, that, well, stocks always move. The chart pattern is always following a particular way. It is always moving in a symmetrical manner. Market applies this law of symmetry. You will never see an erratic move, or you will never see an erratic, suddenly just some big line coming in. That never happens. Market respects, it is always on basis of some calculation. The profit booking also is on basis of some calculation, on basis of Fibonacci, on basis of Bollinger Band, on basis of the previous highs, on basis of seeing the monthly charts. So it always respects the previous highs, the previous lows. So this is what we mean. Now look at the first diagram. We are seeing the double top. What do we mean by double top? Double top is when, as we said, that history repeats itself. So now this is what we see, the uptrend taking place. We see the reversal taking place now, and it has come now. This is where the support has taken place. So a good smart trader will start buying stocks when it comes towards the support level, and then you have a look, is it falling, or is it going below the support level? No, it is just taking its own time. There is some buying interest, and suddenly you see that yes, there is one big candle emerging, which gives you a confirmation that it is a time for an uptrend. Why so? Because it has managed to move past the previous highs. So that is a confirmation. Refusing to make new lows, trying to move past the previous highs, and that is when you know that yes, an uptrend has begun. Now if you have made an entry, how will you gauge? Without any other indicators, how will you gauge? You will go to the prominent candles. When you are here, you will first say that yes, our target is up to this. Once you have witnessed this upward move, what is the next move? Well, you wait and watch. You see, you be ready with your trailing stop losses. The stock is ready. It is healthy. It is robust. It is moving past the previous high of this candle also. So how will you then infer towards the next projected target? See your past data. See the past high that we have witnessed. And that is what we mean that yes, the stock has managed to respect the previous high levels. But now, is it ready to go move past that? No. We are seeing that yes, there is selling pressure coming in. So market is not ready to move past this particular level, and we see reversal. As I explained, the rules are the same. It is very, very simple. No new highs being made. Close is coming towards the lows. There is fatigue, and then it is confirmed by big fat red candles. So that is what we mean by double top. And similarly, same way, we are witnessing the same rule for double bottom. So we know that, well, the worst is over. We now need to get into this stock because it has taken support at the previous low. Now, once again, when this stock we always see the past data. Right now, I'm talking only about the chart patterns because we are not taking help of any other indicator. So if your visual eye appeal has to be there, when you are a chartist, it is your eye appeal. You may not be good in your mathematic calculations, you may not be good in Excel, but if you have good eye appeal, when you are seeing a chart, the chart is actually talking to you. So now look at this. We see the red candles making new lows, and then we see subsequent that yes, the subsequent candle we are seeing it is closing towards the previous high, and then subsequent we see a confirmation coming in. So what are you going to aim at? You will aim at a target level of these cluster of resistance which we see by these candles. So similarly, so see, this is what has happened. It just managed to move, and this is where you start putting your trailing stop losses. You may use your true. Now if you are a hardcore trader, if you want to get, what will you do? You will book your 50% at your resistance level. You will then start keeping your trailing stop loss, or if there is a dip, it will give you an opportunity to rebuy this stock, because if your supports and resistances are taken care of, you will again get an opportunity to get into the stock, and then you will start keeping your trailing stop loss, so that is where you are in the best of the trade. Now you see that yes, the stock is showing resistance, and again we see that the fall has taken place. Now, where is the bottom taking place? Do you see? It is more or less at the same support level which was taken earlier. And now we see the good run coming in. Now, your aim projected target should have been what? We first see if you are an aggressive trader, you buy at the bottom that yes, this is the support. Let's take a chance with a favorable risk reward ratio. Let's take a stop loss below the low of this particular candle, and let's get into the trade. That is what how the aggressive traders would do. So what would be a near term? You are going to be playing safe. So what are you going to do? Your aim would be to aim for a target of this level. Once the stock is picking up, you may add to your script and then aim for a target of the previous prominent high. You may book your partial profit, or you may book totally. But once you see a price movement confirmation that it has moved past, it is a confirmation that it's ready for the next up move. It has given a breakout. This is what we mean by a breakout. Now you see this is going to be, you are seeing continuous resistance. First, second, third, and four attempts. Normally the second the third attempt gets stronger. So you have to look at that also. So seeing the past history, if you see that the stock is making an attempt to go towards the high, the stock is ready, and this is what we saw first, second, third, and fourth. It is a very, very strong likelihood of a breakout. So this is when you go all out to get into the stock, because the stock is ready for a new high. Now, when we spoke about the sideways move, so this is what often occurs in a sideways move, because market is taking its own time. It's waiting for some confirmation. There is something likely to happen. It is an indecisive move. That is why the stock or the index is getting into the sideways move. So that is when the triangle formation occurs. So triangles are some of the most, how do we come across these? Trend lines really help us. Trend line, and how do we draw the trend line? By connecting the supports. So if you see in each and every example, we are trying to join the dots of the prominent lows made, and that is why this is an ascending trend line, this is a descending trend line. When the stock is not ready to make a new high, that is when we are getting a descending trend line, and when it's making a higher low, we are getting an ascending trend line. And when you see a breakout from either ways, you see that yes, the stock is ready for a decisive up move. So this is the similar pattern what we have seen, that yes, the resistance is at more or less at the ascending trend line, higher lows, but the highs are more or less at the same level. And same way in the descending triangle, we are seeing that the supports are more or less at the same, but the stock is refusing to make new highs. So this is a sign of a bear. Ascending triangle is a sign of a bull run, and symmetrical is, well, it's a wait and watch scenario. So traders will get into the long position on a breakout, a decisive breakout of a trend line. So either way, so symmetrical, when there is no clarity, it is just well within the range. Ascending means higher lows and descending means lower highs. So this is what the patterns are telling us as to how to be prepared when the move actually takes place. Now, flag and pennant. These two short-term chart patterns are continuation patterns that are formed when there is a sharp price movement followed by a generally sideways price movement. So this pattern is then completed upon another sharp price movement in the same direction as the move that started the trend. The patterns are generally thought to last from 1 to 3 weeks. So in-depth study, I think one should, once you get the grip of a particular pattern or a particular this, one should do a detailed study, and there are various books also, and it's not necessary that you have to know it all. Once you it would be fine if you know just 2 to 3 indicators also very well. That will help you to make your own trading strategies, that will help you to gauge as to how and what you are looking at. So this is what we mean by a pennant and a flag. What we just spoke about, that it is for short term, it is just a small movement, but it gives you very quick up moves or the side downward move. So similarly, this is a wedge. The wedge chart pattern can be either a continuation or a reversal pattern. It is similar to a symmetrical triangle, except that the wedge pattern slants in an upward or a downward direction, while the symmetrical pattern, it is indecisive. It doesn't give us any clue whether we are heading upward or downward. We have to wait for a clarity, because the support and the resistance are more so, it is in a range bound mode. So the other difference is that wedges tend to form over longer period, usually between 3 and 6 months. So this is what is a sideways, an example of a sideways move, whereby there is no clarity. And this is when the traders are put to test, and we really need to be happy with the small. If you want to get into the trade at such a time, because you're never going to know as the trend has begun or no. But when you see that, yes, the stock is not ready to make new highs, the stock is not ready to break the support, you come to know that this is a sideways. So one often buys at the support levels and exits at the resistance level. So support is the price level through which a stock or market seldom falls. Resistance, on the other hand, is the price level that the stock or the market seldom surpasses. So these support and resistance levels are seen as important in terms of market psychology and supply and demand. Support and resistance levels are the levels at which a lot of traders are willing to buy the stock in the case of support and sell in the case of resistance. So this is where one really needs to be vigilant, support and resistance, because see, in such a narrow move, once you've missed out the opportunity, half the rally is already over, whereby your risk reward is also not going to be favorable, and you are going to miss out on your maximum opportunities that one can get. So as we spoke about trend line, now this is a clear explanation as to how the trend line is working so beautifully for us at this rally that is shown on the chart. A trend line is a simple charting technique that adds a line to a chart to represent the trend in the market or a stock. Trend lines are usually used to clearly show the trend and are also used in the identification of trend reversals. What do you mean by a trend reversal? So far, yes, these are giving us buying opportunities. What is happening? The stock is continuing to make higher lows, higher highs. At every juncture, it is trying to take support of the trend line, and whereby we are seeing a new round of momentum taking place. But once, when you see that, well, we have enjoyed the rally right from 7 to 17. And once, if you see that, well, the stock is not ready to move past the previous resistance level, and it is going to come to the support. And if this support is going to be broken, we see a close, because sometimes the market tries to scare us. It breaches for a minute and it again bounces. So the confirmation comes only when we see a close below the trend line. So this is what we mean that trend line is helping us to see whether there is a trend reversal. So trend lines are used to clearly show the trend and are also used in the identification of trend reversals. An upward trend line is drawn at the lows of an upward trend. This line represents the support the stock has every time it takes and it moves from a high to a low. Now, similarly, a downward trend line is drawn at the highs of the downward trend. So this is what we are trying to see is the resistance to sell at every high and to go at book the profit at new lows. So this is how we take support of the trend line, and that in this too can help us in trend reversal, because once the stock moves past from the low to the high, you are getting a reversal. So this line represents the resistance line, where this particular one is the support line. So in a falling market, the trend line acts as a resistance, and in a upward market, in a moving market, we see it as a support. Now we will get onto the indicators. So with the support of indicators, just chart reading will be insufficient. We have to take support of some indicators, which will give us some more clarity, some more calculations as to how you can come towards your targets. So indicators are the tools that derive its value from the original price of the security. There are different types of indicators with various kinds of usage. Mainly, there are three types of indicators: trending indicators, momentum indicators, and mathematical indicators. So these indicators, now let's know something about the trending indicators. Two of them would be like the moving average, that is one, and combination of two moving averages and the crossover of these two moving averages. So let's go get in detail on this particular subject. So what is a moving average? Moving average, it is either a simple moving average or a exponential moving average or a weighted moving average. So weighted moving average, it gives you more data of the previous bars, just the recent previous bars. So commonly used depending on your trading strategies, whether you are an intraday trader, whether you are a long-term trader, or whether you are an investor. So on basis of that, whether you are using a 5-minute or a 15-minute or a half an hour or intraday or hourly, whatever, you have to use your, so most of the commonly used moving averages are 5, 20, 40, 60, 100, 200. Now, even if you read, if you would have heard many of the analysts talking on the television channels, 200 is quite a barometer for most of the traders. They say, okay, 200 holds as a very, very strong resistance. Once the market is in a bear market because it is below 200, the market comes in the bull market because it has come above the 200 moving average. So these are the ways when people try to make their judgment. So moving averages is made with the use of the price, what is seen in the previous 5 or 10 or 20 bars, and on basis of that a moving average is made. So longer the time span, the less sensitive the moving average to daily prices changes. So what happens is, if you are an intraday trader, a 200-day moving average or a 200 period moving average is not going to help you. You would make use of a 5 to a 20 or a 14 to a 20, 30. That way you would use a combination or even a single moving average. Once you see a crossover, you will get your buy strategy, and that is how you can generate your buy signals, and vice versa. Once it crosses the once after making the high, it crosses and makes a low, it is a crossover, and which shows the sell strategy. So using the moving averages of different parameters like 5 to 20, and even with the short and the long term, when the moving average crosses over, when the shorter term moving average crosses the longer term, that means it is a clarity that yes, that it is gaining further strength and it is time to go all out into the stock. Now comes the oscillators. An oscillator is an indicator that fluctuates above and below a center line or between set levels as its value changes over time. Now there are two types of oscillators: centered and banded oscillators. Now, what are the centered oscillators? Most commonly used is the MACD. MACD, the center line comes on 0. So the minute the indicator rises above 0, that means the stock is getting into a trend and it is getting into an upward move. It is comparatively slow, but well, it gives a clarity on the trend. So centered oscillators, they fluctuate above and below a center point or line. They are best suited for analyzing the direction of price movement, and examples are MACD and ROC, that is rate of change. Now the banded oscillators, well, these are the most commonly, and RSI is very, most of the time the favorite for everyone, easy to understand, gives you a quick overbought, oversold judgment, and also in the bull run. RSI, I was told that yeah, many are interested in knowing, so we shall talk quite in detail on this particular subject. So banded oscillators, they fluctuate between overbought and oversold extremes. They are best suited for identifying overbought and oversold levels. RSI and CCI, these are the favorite indicators which is used by the traders. Now, momentum indicators. So these indicators show the trend of shorter period. They also show the velocity of the trend and overbought, oversold position of the trend. Some of the popular ones are relative stock index, stochastics, rate of change, moving of average or convergence and divergence, that is MACD. So RSI, relative strength index, is compared to stochastic, is a smoother one. Stochastic keeps changing. It is more so for quick traders. Stochastic indicator is used more by quick traders. RSI is comparatively gradual and a smoother indicator. So let's talk about the relative strength index, the RSI. So RSI is a momentum indicator used in technical analysis, and it measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the price of a stock or asset. The RSI is displayed as an oscillator, a line graph that moves between two extremes and can have a reading from 0 to 100. So normally when you study the in a regular market, the oversold zone is 0 to 30 and overbought zone is 70 to 100. And in a bull market, it is normally 0 to 20 and 80. So 80 is the oversold and overbought, and oversold comes to 20. Whereas in sideways, we observe the range of 30 to 70. So traditional interpretation and usage of the RSI are that of the values of 70 or above indicate that the security is becoming overbought or overvalued and may be primed for a trend reversal or corrective pullback in price. An RSI reading of 30 or below indicates an oversold or an undervalued condition. The RSI provides technical traders signals about bullish and bearish price momentum, and it is often plotted beneath the graph of an asset's price. So now we shall study in depth about the RSI. So this is the chart pattern what we are seeing of a particular script or an index, and we are making use of the RSI. Now as we spoke that, well, by default we get 30 to 70. Now the 30 band is the oversold and the 70 band is the overbought. Overbought, as explained, that it is heavy. There is likely to be some exertion coming here. There is likely selling pressure to set in from here on. And likewise in the oversold zone, that means that the market is ready for a takeoff. There is a likelihood of a trend reversal. So let's go step by step. Now we see that there is a downfall, whereby the indicator has already got into the oversold zone. Now, does it mean that the stock, when it gets into the oversold zone, are we ready to buy it? No, not necessarily. One should never do that, because if we are heading for a bear run, which we only come to know eventually, because one can never judge whether we are already getting into the bear run. It only happens once we see a pattern occurring. So when we are seeing that the RSI has got into the oversold zone, it need not necessarily mean that the worst is over. It may mean that, well, there may be minor pullback, and we may see further next round of selling pressure setting in. So this itself, being an oversold, cannot help you to make a judgment that yes, it's time to buy a stock. We will wait for some time, let the market show us some conviction, and we are seeing that, well, it made an attempt. You see here, the RSI has got into it, but the stock is not ready to make a new high. But once the RSI has closed and it has come above the 30 level, it needs to comfortably cross and sustain above 30. That is the time when you know that the worst is over. And you see the previous high, the reading is similar to how we would read the chart. And once we see that the stock is, the RSI is progressing and trying to move past the previous high, you know that yes, there is a likelihood of a trend reversal and the stock is ready to move upward. Now, another point to notice is that whenever this RSI is hovering around, say, 45 to 60 band, that means the stock is holding on. It is just consolidating, but it is ready to show further strength. And when RSI is at 60 and above, that means it is, the price movement is also going to be at its maximum. The market is going to get into the euphoric mood. So this is what we have seen. Have a look at the RSI movement while the price was every time making consolidation, but the RSI was telling us that yes, there is no weakness. So you see the median line, the 45.50, more often than not, it has held on. So that was giving you further buying opportunity in sync with the supports being respected by the price movement. I would request everyone to mute because there is disturbance. Yes. So this is what we have seen. And now when we see that the RSI is resting at 60 and above, we are seeing that there is a euphoric move. This is the example where we have seen that yes, once it is getting into the 60 levels and above, market is at its strong upward move. Now let's see over here, it has got into the overbought. So we know that yes, be cautious, wait for a reversal. And when we see that the 70 line is broken down, it is a confirmation that yes, the market is ready to correct. Now, a common observation in the RSI is a negative divergence and a positive divergence. What do we mean by a negative divergence and a positive divergence? Negative divergence is when the stock is continuing to make new highs, whereas the RSI is failing to make the new highs. It is showing exhaustion, it is making lower highs. And when it breaks the resistance level, the 70 band, that means it's a strong conviction sell. And similarly, a positive divergence is when the stock is making new lows, whereas the RSI is failing to make new lows, whereas it's continuing, but it takes support of 30 trend line. There is an occurrence of a positive divergence, which gives us a conviction buy. But are all negative divergences and positive divergences making sense? No, not really. This is when you make use of your further other indicators, and that could be your Fibonacci plays a very active role, because the positive and the negative divergences play a very, very vital role when the stock has come to a significant resistance level or a significant support level, which we can take from the Fibonacci levels. So now we talk about the MACD. So MACD is a trend following momentum indicator that shows the relationship between two moving averages of a security's price. The MACD is calculated by subtracting the 26-period exponential moving average from the 12-period exponential moving average. The result of that calculation is the MACD line. A 9-day EMA of the MACD, called the signal line, is then plotted on top of the MACD line, which can function as a trigger for buy and sell signals. So this one need not learn as to how it is coming, because one gets any program you are using, all these indicators come by default. You need not know the calculations, but you just need to learn as to how to use these indicators. The speed of the crossover is also taken as a signal of a market as is overbought or oversold. MACD helps investors understand whether the bullish or the bearish movement in the price is strengthening or weakening. So this is how the indicator is used. As I mentioned, this is the 12-period EMA, and over here it is the crossover of the 9, which helps us, giving us that there is a trend formation and the strength comes once it crosses the 0 line. So this is what we have learned today. Thank you for listening to all this. And for all our CA students and members, we have a very good offer. Those who are interested in opening an account and wanting to know more from us, please get on to this link and contact us for all the benefits that one can enjoy. I talk today.
Thank you so much, Vaishali ma'am. We really understand now that market is not just, it is not a gamble. And thank you for giving us so deep and so, so many things that we didn't know at all, actually. And it is a very well calculated way of going ahead in the market. So right from the trader to the investor, there is something for everybody here. We can understand that very well. So I would like to ask people, if they have any questions, they can just post it in the chat box, or maybe ask ma'am. Yes, anybody? Ma'am, Prakash has asked that please explain the time frame for day trading, swing and positional trading.
See, the time frame for day trading, I think 15 minutes. I mean, you have to have the grip. People who use could be, first you start with half an hour, because 15 minutes is going to be too quick for you to decide. So if you are a newcomer, I think one should start with a 30-minute right, for an intraday. But once you start understanding, you may get into the 15-minute or even 5-minute time frame.
Okay. And so he has another question, that which are the other technical indicator which can be used with RSI to reach the buying decision for a specific stock?
So see, RSI and moving average helps a lot. Along with that, even Fibonacci scale helps a lot. It could be a Bollinger Band, because Bollinger Band also helps you because, once there is a squeeze, there are many terminologies. But right now, as a beginner, I think with RSI, moving average would work very well.
Okay. And Nirali is asking whether day trades should be hedged.
Well, if you're really very quick, you can do your option strategies, but options go very slow. So I don't think you should do that.
And is averaging helpful, she's asking?
So depending, once you understand the trend, once you know, like now example, if you are a fundamental analyst and a technical analyst, so suddenly the stock has fallen. If you understand the market well and you combine the what and when, then of course averaging makes sense. That is when certain stocks which like banking stocks or FMCGs, these are all never going to go out of fashion. So that is where, you know, we recommend SIP strategy, like you buy at every level. So averaging would work well in those.
All right. Yes. So Mayur is asking whether stochastic RSI is better than RSI intraday move.
Well, I'm very comfortable just with RSI.
Okay.
So you have to, as I said, just have a grip on 2 to 3 indicators with wherever you are very comfortable, just use those.
All right. Yes. And if you can give some idea on the dollar index, Kushal wanted to know if I don't know whether it is
No,
relevant.
I'm not tracking dollar index
Okay.
on a day-to-day basis. Yeah. And now Fibonacci, somebody is asking me about Fibonacci. Now Fibonacci is a very vast subject. It cannot be answered in 1 or 2 lines. So, but Fibonacci is a calculation. One must read this in detail and and then maybe in future we can go in depth on this particular subject as well.
Yes. Yes.
Whether patterns work in all time frames, yes, definitely. The rules are the same. They are applicable for whether it's a 5-minute chart to a monthly or a quarterly. Patterns work well for all time frames.
Right.
But in an intraday trader and all, you know, by the time you think of when, you can't go in depth. So patterns, really, one doesn't really care much for patterns in an intraday. You just see the crossovers and volume, you know, those are the pickup.
Right.
So I guess I have answered all the questions. Good book to understand this. Well, for different topics, there are different books. So to start with, well, Martin Pring, why don't you go to, instead of books, let's start with Investopedia, even Wikipedia. They give very vivid detail on each and every topic. And then some of the books are also recommended. So Martin Pring is a very good book. It's from old but yes, to start with, I have started with Martin Pring.
All right. Sure, ma'am. Thank you so much once again. It was a pleasure having you. And Kaival, would you like to add on anything? Otherwise, I think we are really, really enlightened today.
Yeah, I'm sure all the like the technical analysis which ma'am had told would surely help all the chartered accountants, those who are present here, and I'm sure that it would not even help in making profit, but it would also help in minimizing their losses, which is the most important part in the trading. And
yes, discipline is a must.
Yeah. So thank you so much, ma'am, for enlightening all of us with your great experience and knowledge and taking out your precious time. Thank you so much, ma'am.
Sure.
Thank you, ma'am.